Good afternoon. Welcome to our first quarter 2019 update for our U.S. value strategies. I am Valerie Arnold, co-head of North American distribution at Pzena Investment Management. Here at Pzena, we are solely focused on one thing, value investing. We have been using the same disciplined value investment process for more than 22 years. We apply this same process to all markets, from domestic small cap through large cap, international all the way through emerging markets. We are a global research team of 25 professionals. We are business people evaluating businesses. We use fundamental research to build our value-oriented portfolios from the bottom up, company by company. We seek to buy good businesses at low prices. We focus on companies that are underperforming their historically demonstrated earnings power. We apply intensive fundamental research to these companies in an effort to determine whether the problems that cause their earnings shortfall are temporary or permanent. We include companies in our portfolio when all 5 of the following criteria are generally met. The current valuation is low compared to the company's normalized earnings power. The current earnings are typically below historic norms. The problems are temporary and not permanent. Management has a credible strategy for earnings recovery, and there is meaningful downside protection in case the earnings recovery does not materialize as expected. What differentiates us from other investment managers is our relentless commitment to value investing under all market conditions. We have a unique team-oriented culture that allows us to stay invested in the cheapest part of the market throughout an investment cycle, which we believe provides the best long-term alpha for our clients. I am here today with John Flynn. John has been with Pzena Investment Management for almost 14 years, and he is a portfolio manager on our U.S. small, mid, and large cap value strategies. And now let me turn it over to John.
Thank you, Valerie, and thanks to everyone for joining us today. On today's call, we'll discuss the opportunity that we see today in financials, a sector that we have significant exposure to in our large cap portfolios on the domestic side, as well as throughout our non-U.S. portfolios. Let's start off by looking at the investing environment in the market as a whole. The market recovered to start the year after a rough fourth quarter last year. Growth once again outperformed value and spreads widened. This first chart here shows the dispersion of valuation between the first quintile, or cheapest stocks, and the fifth quintile, or most expensive stocks. And it is expressed in standard deviations. When the spread between the valuations of the cheapest and most expensive stocks is in line with historical norms, this chart would be at the 0 point. Today, we stand at more than 2 standard deviations above that average or 0 point. To give historical context, the only time we have seen wider spreads in the past 55 years was during the dot-com bubble. While spreads can continue to grow wider, the starting point is important, and at today's level has usually led to longer-term outperformance for value stocks. As an example of this phenomena, this chart compares the relative PE multiples of 2 highly regulated capital-intensive businesses, utilities and banks. Utilities PEs are nearly twice banks, and this level is in the 97th percentile over the 54-year time period for which we have data. Again, this phenomena can persist and perhaps even grow wider, but as value investors, these are the types of opportunities that excite us. Said another way, and perhaps a little simpler, investors today are paying almost twice as much for utilities as they are for financials. There are 2 components to how this chart was constructed: expensive utilities, and more interesting to us, the cheap financials. Here you can see that on a price-to-book basis, financials are as close to as cheap as they've ever been relative to the market over the past 45 years or so, which seems like a pretty good starting point. We've been getting a number of questions from clients wondering if we're entering a recession and the impact on a portfolio if we were to go into a recession. The conventional wisdom seems to be that you don't want to own financials if we are about to go into a recession. But when you look at the data, you can clearly see a recency bias in the conventional wisdom. As I mentioned, valuation matters, and more importantly, the starting point for valuation entering a recession matters. On this chart, we plotted where price to book stood 12 months prior to recessions. As you can see, financials are cheaper than they were 12 months before the last 4 recessions, and again, that's important because the starting points matter. When you compare financials today versus where they were prior to the last recession and the global financial crisis, you can see how much cheaper we are today. In other words, the market seems to be predicting the next global financial crisis in the current valuation, depressing the multiple. This chart here shows the 3-year performance of financials relative to the market from every month leading into a recession for the 24 months prior to that recession. For example, point 24 is the 3-year relative performance of financials from 2 years before the recession, and point 0 would be the relative return from when the recession started until 3 years later. The lower half of this chart shows the relative performance of financials when bought before the recession triggered by the global financial crisis. You can see how poorly financials performed relative to the market when bought during this 2-year period and then held for 3 years. That had to do with the permanent impairments suffered during the financial crisis. However, when you look at the previous 4 recessions prior to the global financial crisis, buying financials prior to the recession actually produced a substantial margin of outperformance over subsequent 3-year holding periods, which you can see with the blue line on the top half of the chart. When you compare how financials look compared to that period at the bottom of the chart, or the period around the global financial crisis, you see a banking industry that looks completely different than it did. Over the past decade, the industry has worked hard to strengthen fundamentals, which you can see on this chart here. In the upper left-hand panel, you see that banks have increased Tier 1 core risk-based capital ratios. In the upper right-hand corner, the bank liquidity ratios are more than twice as strong as they were prior to the financial crisis, which adds to balance sheet resilience. And finally, in the bottom panel, you can see that banks have restored earnings despite the combination of low interest rates and increased regulatory capital requirements. Through a combination of cost cuts, investments in technology, and a focus on higher return businesses, banks have largely restored profitability to historical norms in the U.S. and are making progress, though not as quickly, in Europe. Finally, the overall credit environment at U.S. banks is more benign today, and non-performing loans are below their historical range. The one area where we have seen outsized growth is in leveraged loans, and there are some concerns over the growth and loosening of lending standards in this space. We believe that most of the on-balance sheet risk of leveraged loans is held outside of the banking system due to the higher risk weighting and higher capital requirements that banks are required to hold for leveraged loans held on balance sheet. The issue then becomes how long banks warehouse these loans before they move off balance sheet. And banks are turning their leveraged loan inventories as fast as every 60 days, or 3 times faster than during the GFC. We continue to watch for new developments, but believe that any problems surrounding these loans will be limited. Let's now turn to a specific example and look at Citigroup, which was one of the most hated names following the global financial crisis. But when you look at where it is today versus 5 or 6 years ago, you see a company that is benefiting from the fruits of its labor of putting itself through a variety of self-help issues. On the upper left-hand panel, you can see that Citigroup has dramatically cut non-interest expense, which has driven the strong improvement in profitability on the upper right. At the same time, the company has significantly improved its capital ratios on the lower left, and it stands with a capital cushion well in excess of regulatory minimums. The improved operating metrics and excess capital has allowed Citigroup to return about 120% of earnings to shareholders the past couple of years through a combination of dividends and share repurchases. So at the end of the day, what you have in Citigroup is a bank that's trading at 1.1 times tangible book, with a double-digit ROE and paying back more than 100% of earnings through dividends and buybacks, which adds up to a low teens return to shareholders at today's valuation. To sum up, distrust created during the GFC has not been fully resolved in investors' minds, and financials remain heavily discounted, about as cheap as any point in the past 45 years. However, given their profitability, capital strength, and liquidity, we believe financial firms should be commanding higher valuations. I would like to thank you all for your time today, and I'll now turn it back to Valerie for Q&A.
Thank you, John. And now we will take some questions from the audience. John, can you talk a bit more about the leveraged loan market and their potential impact on financial stocks?
Sure. So there's been a lot written and a lot talked about with the leveraged loan market. And I think one of the interesting things that's gone on in the wake of the global financial crisis is this sort of disintermediation through business development corps, BDCs, through private equity funds, and through CLOs, collateral loan obligations, which is where a lot of this exposure sits. And so the direct impact on the bank balance sheet would be limited because they're not holding it on their balance sheet today. So what you then start to worry about and what we look at is, does this become systematic? And there's been some comparisons made to the subprime lending market. The Bank of England has a report out because the size on the surface appears to be similar. A couple of things are very different that I think are worth highlighting. When you look at the subprime lending market, that was a housing bubble where we were well above trend in terms of valuations, and we were making loans to unqualified borrowers at loan-to-value ratios that were very, very high, which precipitated the crisis. Today, when you look at the levered loan market and you look at private equity valuations, we're on the high end of the historical range, but we're not setting new records in terms of valuation yet. And there often is significant equity layers below this as well from the company standpoint. So certainly there's the possibility for a credit event through the leveraged loan market. The bank's exposure to that is contained because of the way the market has evolved. And we don't think that at this point it's big enough to be systematic from a risk standpoint.
Thank you, John. Is the story the same for mid and small cap banks? I know you discussed large cap on the call.
Yeah, so we see opportunities within the small and mid cap end of the spectrum as well. But I would say for the banks, the valuations aren't as compelling as they are for the large column money center banks. They're still cheap. They're still within the first quintile, but they're not as cheap. And there's a couple of reasons for this. One, I think the regional banks had a bit more of a cleaner recovery coming out of the crisis as they worked through their loan books. They don't have the capital market businesses that the Citigroups of the world have, which there's been some depressed activity there. And then finally, there's an M&A premium in the small and mid-cap banks that I think drives the valuations up a little bit higher there.
Thank you, John. Is it just the banks that are historically or at a historic level of cheapness, or are other industries within financial services also cheap?
So yes, we're seeing, banks are one great example of the opportunity we're seeing within financials, but we certainly see it extending beyond just banks. If you look at our portfolios today, we have exposure to both life and P&C insurance through someone like MetLife, someone like AIG, who has done a lot of work to reposition their underwriting activities, but they still have some adverse developments on their back book that is giving people concern. And so we think it's a pretty compelling valuation opportunity there today. And then the other area within financials that we see opportunities are within asset managers, with the investment managers, traditional investment managers, and alternative investment managers, where people really don't know how to value the carried interest in terms of the equation there. One thing that, depending on what index you're looking at in classification, that comes up within financials sometimes is REITs. And I think it's worth just pointing out there that REITs, similar to utilities, we see valuation still as very expensive and don't really see much of an opportunity there. So our portfolios are more towards the banks, the insurance, and the asset managers.
Since there are no other questions, we want to thank everyone for joining the call today. John and I greatly appreciate your interest in our firm. Please see our contact information on the screen. For further information, you can find us at www.pzena.com.